Welcome. It's time for, once again, the Daily Objective. Jonathan Hoenig with you with a great guest host, Seth Levine from the Integrating Investor. Welcome, Seth. Happy to be with you.
Hey, glad to be here. Thanks for having me back.
Seth can be found, of course, at integratinginvestor.com and on Twitter at SethLevine.2. But even more importantly, we've got a great, sorry, I'm turning off my repeat here. I'm so sorry. I'm hearing a repeat here. Let's just kill all this. All right. What do they say in the business? Something like take two? Can you hear me? Thank you. All right, let's start it over. And my apologies to all, especially to our real guest, Keith Weiner today, Dr. Keith Weiner. Thank you so much. I apologize for that distraction. I think it obviously goes to show that big tech is a monopoly, needs to be broken up. They're at fault for this, so we'll blame them first. But thank you for being with us. If you know anything about precious metals, Keith's face is probably familiar to you. If you're an objectivist on Facebook, you probably know him as well, or Twitter. He is the president of the Gold Standard Institute, USA. He's also the CEO of Monetary Metals. He is more than anything a leading authority on everything metals, everything gold and precious metals, not just in terms of being frankly a shill like a lot of other gold-oriented people are. Peter Schiff comes to mind, but an expert on the financing. And in fact, part of what Keith's firm has done is come up with a real innovative way he's going to tell us about that you can actually earn money on gold, in gold. This hasn't been done before, or I guess, Keith, it has been done, but it was done decades and decades ago here in the States.
Before 1933, bonds were gold bonds. The investor had a right to be paid in gold coin. And of course, 1933, President Roosevelt comes along and makes it illegal to possess gold. And he also abrogated the gold clauses of everything from long-term rental agreements to debt instruments, and said, no, from now on, you're going to get paid in our new scrip, paper scrip.
So earning a payment in gold actually became outlawed at that time and really never came back. And I want to get into that a little bit. I also want to tease that we're going to have a special announcement here for the Ayn Rand Center UK coming up at the end of the show. So you don't want to miss that at all. But Keith, maybe a good place to start is kind of with, as they say, one's origin story in the gold world, but also maybe in the objectivism world. As I understand it, for example, you weren't a gold guy way back. You actually came from the software world. Something, Rand wrote a lot about gold. We're going to get into that, but she didn't write too much about software, did she?
So in college in 1986, I remember arguing with this. I took a constitutional law class as an elective, and every time the professor said quasi-public, that made my blood boil, because he was basically saying that then the government takes over and tells you what you can do with your property or what you can't do with your property. And there was all kinds of cases about a shopping mall that put up a nativity scene and things like that. And I kept arguing with him. I don't know why I was arguing with this guy about, it's government takeover, it's socialism. And so somebody came out to me after class and he said, you must have read Ayn Rand. And I said, no, but you're like the third or fourth person who's mentioned Ayn Rand, so let me go and read. So I went to the college bookstore and they only had one book from hers, which is Atlas Shrugged. Picked that up, plowed through that. And then by the end of the year, I had picked up and read all of her other books that were available at that time. And so considered myself an objectivist from around 1986. Was aware of what she had said about gold and what Alan Greenspan ironically had said in his essay in Capitalism, The Unknown Ideal, what he'd said about gold. But yeah, I was a software guy. I was building a software company, which I sold to Nortel Networks. The deal closed August 19th, 2008. That turned out to be the last acquisition that Nortel ever did before it went bankrupt. And
Great timing.
which is
I hope it was
historical
a
fact.
cash deal.
It was a cash deal. I did get a little bit caught up in escrow and some other things, but it was a cash deal. Financially, I did very well out of that. And it's a historical fact. That was the last deal that they did was our deal with Diamondware. And probably one of the last exits, although I don't have any data on that. I can't imagine there were too many more exits that would have occurred after, maybe a few more in August, but by September already, everything was cascading over the edge. And so at first I started to study economics and markets to figure out how to protect myself. That was 14 years of my, hard work and risk to get to that point, and I didn't want to lose it. And the things that were happening were clearly a lot more than just a correction. Mm-hmm. So that eventually takes me to this Professor Fekete and his new Austrian School of Economics, not accredited, but ultimately I became his student, ultimately was awarded a PhD by him. Again, not accredited, but the work was real. And what I studied was monetary science, how to really understand this as a science and not the way most people kind of approach a quantity theory of money, for example. And then realizing that gold had something to do with the solution. When the dollar finishes blowing itself up, you could debate how we're going to get back to gold, but one way or the other, gold is going to be the one thing that's left standing when the paper system blows up. So I wanted to be part of the solution. If it was a normal world, I would have done another software company, but I wanted to be in the solution. So I said, okay, I want to do a gold company. And then, gradually from there, the ideas began to coalesce as to how exactly to do this.
Well, we teased your episode because in everything these days, it's like, I don't know, a decade ago, it had to have Kardashian in it. Now it's got to have Bitcoin in it. But, you teased, gold is in effect being the solution to the problem. A lot of people now, playing devil's advocate, obviously your doctor would say that Bitcoin is the solution to that problem of debasement and inflation. You teased a bit what Ayn Rand and really Dr. Greenspan had written in her book, Capitalism, the Unknown Ideal. I'll share that briefly if you want. I know you're very aware of it. I'm not sure our audience is. First, this is just a screenshot from your website, which I encourage everyone to check out at monetary-metals.com. But Greenspan wrote, and I know under Rand's, particular tutelage and governance, quote, in the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value. People look at that and they say, well, but Keith, gold just sits in the ground. It doesn't do anything. I can put my money in the stock market. I can put my money in commodities, something that's going to go up in value. What good is gold?
That's right. Well, gold is kind of the uninvestment. It's the thing you own when you don't have a counterparty that you trust or the projected return that you get. So if you look at stocks today, what's the PE nowadays? Or I prefer to look at it as what's the either earnings yield or better yet, dividend yield, at or near all-time record lows. So, you're taking the risk that, that could, even if that reverts to the mean, that is going to be a blowout of 50% loss of capital or something like that. The Bank for International Settlements defines a term that they call zombie corporation. And it reminds me of the movie Broken Arrow, which is not a movie worth seeing, but there's one great line when, as I recall, they're saying to the president, sir, a broken arrow. He says, what the hell is a broken arrow? And he says, a nuclear warhead's gone missing. And the president says, I don't know what's worse, that a nuclear warhead's gone missing, or apparently it happens so often you all have a term for it. So zombie is like that term. And, more than 15% of all publicly traded corporate debt out there is zombie debt. And it's a little bit more involved than this, but a zombie corporation is a company with profits less than interest expense, meaning they can't even service, let alone amortize the principal. They can't even service the interest without ever more forgiving credit markets and ever lower interest rates.
And this Seth, this is what you do in your real life, and not your real life. You're a debt analyst. I mean, is this Is this congruent with what you're seeing in your analysis of the debt markets right now?
Yeah, I mean, well, of course, I'll leave my professional opinions aside. These are just my personal views. But yeah, I mean, obviously, if you look at, let's take companies out of it, just so I can speak a little bit more freely. But if you look at the just debt to GDP of America, right? Debt has only gone one way. It's gone up. I think that's pretty consistent also when you look at other kind of fiat currency regimes. So, in a lot of ways, history is rhyming right now. So I would agree with Keith.
Well, Keith, what does it look like? Oftentimes it's like people who are interested in gold are associated with kind of doomsday. You wake up and there's fires, the ATMs don't work, the network's down. I mean, and even some of the sophisticated investors I work with say, you've got to own gold for a rainy day. But inflation isn't like a one-day cataclysm, right? It is a slow, insidious, evil process in that sense. So that it doesn't happen just erupt one day. It happens really at first slowly over time, doesn't it?
Yeah, no, absolutely. Although I believe at the moment the monetary forces are actually pushing consumer prices down. I just gave a talk at the Mises Institute last Saturday, and talking about inflation and deflation, and essentially arguing that you have two different kinds of forces that act on prices. You have non-monetary forces, which I put into the category of what I call useless ingredients. Every time the regulators or the taxinators come along and say, now you have to have ADA bathrooms, and now you have to have an ingredients list for and a calorie count for every item in your restaurant, and now you can't use monosodium glutamate, and now they just, you have to put ethanol in your gasoline, and they keep driving up the price, but it isn't monetary. And when people use the word inflation, they're kind of conflating two fundamentally different kinds of things. But on the monetary side, if you have falling interest rates, essentially that is a fresh new inducement or incentive to every producer of everything. If you didn't want to borrow at 4% and now they lower the interest rate to 3%, maybe it lures you in. And maybe if you didn't like 3%, how about 2.5%? Okay, so how about 2%? And the interest rate keeps going down. And every time it goes down, it makes somebody's business case to borrow and expand capacity. So if a hamburger restaurant now borrows more to build more hamburger places, then the law of supply and demand says hamburger prices go down. And so a falling interest rate environment is an environment of soft, if not falling prices. And I absolutely think we're still in a falling rates environment. Now in the UK, you have 0 to negative interest rates. In America here, we still have a positive interest rate, although not by much. And the interest rate collapsed from January a year ago. I think the 10-year treasury was 1.8%, something like that. And then, COVID hit, and then it collapses to 50 basis points. It's been bouncing since then. We're at 1.6. And something tells me we're not going to actually make it back up as high, right? So it starts here, it falls, it bounces. I don't think it's going to bounce back to where it was. I think it bounces a little bit lower, and then it, so there's jitter and noise in the signal, but it's a falling trend. And the problem with a falling interest rate is it increases the burden of each dollar of debt on the debtors. So think about net present value. The price of the bond goes up, and that's a great capital gain for the bond speculator. But what does that do to the bond issuer?
Yeah, or it even goes the other way. What happens if interest rates go the other way, right? It's called the duration risk in bonds, right? And what if or I would even say it doesn't even just have to be interest rate per se, but even if inflation goes up, the fixed income instruments that you own now have never been more sensitive to to quote unquote inflation, right?
That's right.
Yeah, but I mean, I don't mean to switch topics here, but like Keith, I'm super interested in this gold-backed bond idea. Like, I'd love to hear more about it, kind of what it is, kind of the mechanics behind it, and kind of maybe like what how it works, and just the use case behind it, kind of the thesis
it's something that everyone else can participate in ultimately.
Oh, yeah.
Well, so this one is closed and done, but we are open to investors. They have to be accredited to participate, but yeah, we're doing this not to just be for institutions, but to be for everybody who owns gold, which is largely individual investors. When you talk
Mhm.
to the institutions, they don't generally own gold. It's just kind of a bizarre, that's where the world is today. So, there's two fundamentally unnatural and unnecessary risks that are created by our system, and one is interest rate risk, and the other is currency risk. So if you are, let's say, a gold mining company, although we have other verticals that we are working on bonds with as well, if you're a gold mining company, you literally produce gold by pulling it out of the ground. Now, if you borrow, and of course, every gold mine has to be financed. If you finance it in dollars, you have a mismatch between your asset and your liability.
Yeah. Kiss of death.
Right. So you're basically taking a risk that if the price of gold were to drop, you could be insolvent and unable to pay. And so, of course, you can hedge. And, the major banks that lend to the mining companies require them to hedge. A lot of times that hedge is actually a pretty dumb hedge. It just puts it in the other direction. Then it makes them sell the gold forward. So now if the price goes up, they're screwed. But if the price goes down, they're happy.
That's right.
But what you really should have, if your income is in gold, is you should have your liabilities in gold. And then it just makes a nice match. So for them, it's simpler, less moving parts, less risk, and ultimately less cost in doing it. And then, of course, the flip side is to the investor. Now you can have an investment denominated in gold, paying interest in gold.
So if I have this correctly, basically you're basically issuing a bond, and the lender, I guess, would start off purchasing it with dollars, but they would get paid in gold in terms of principal and interest payment. Is that the mechanics how it works? So if I lend you $1,000, I can expect to get $1,000 worth, or that's actually an interesting question. How does that work? If as the price of gold speculates.
So you're actually buying the bond, purchase agreement and PPM, the private placement memorandum, actually is denominated in ounces.
Oh, okay.
So if you send, well, just to make the math easy, if you send $1,700, first step is to purchase an ounce of gold. So and we can broker that for you, or you can buy that ounce anywhere. It's a commodity. And you can either buy that through us, or you can literally FedEx us a 1 ounce gold bar, let's say. Then you purchase the bond, and what you were owed back is 1 ounce plus whatever the interest is for whatever the majority is.
Gotcha.
Paid in gold.
So the payments going from the lender to the issuer, through whatever mechanics, are in the middle, it's basically you're giving the issuer some gold. They are, presumably converting that to cash so they could run their operations. But then they are paying the investor back in gold, and therefore they don't have to take any of the risk of the price of gold moving around in either direction. And even if the price goes up, then sort of everyone wins. Whereas in a normal environment, the kind of gold company is giving that away to the hedgers, right? Because normally a gold company would go and to hedge that production, they would go and actually sell forward that production, and they would not be able to participate on the upside. So this way, that the price risk kind of goes to if I have this correctly, it goes to the lender, actually. So like people like me who would maybe lend to it and assume that.
And would own gold anyway. Now you're just going to get the interest on it too, right?
That's the thing, is that's a person who's already chosen to own gold anyway for a variety of different reasons. And now that person has a choice. Would you rather pay to store it at 75 basis points in a vault somewhere, or would you rather get paid interest on it? But you're already taking that risk anyway because of all the macroeconomic factors that we talked about earlier, and many, many more.
And the interest I'm sorry. And the interest is, so the interest payments are actually coming in the form of gold too.
Yes.
Right. Okay. Interesting. So instead of getting like a,
please,
and I guess that's struck at a rate that an investor would be kind of familiar with, right? So I'm going to lend to you, and it's going to be, I don't know, 8%, but it's 8% of gold ounces, right? Or 8% of gold mass, as opposed to 8% of nominal value of dollars. Is that the way to think of it?
That's right. So if you put in 100 ounces of gold and the interest rate is 8%, you get back 108 ounces at the end of the year.
At the end of it.
Or
Oh, it's a
Very cool. It's a
one-year
really new way of
Right,
thinking
yeah, okay.
about it. It's truly divorced. I want to pull up a chart of gold actually, because some of our viewers might and our listeners might not be as necessarily familiar with following some of the recent action in some of these markets. And this first one is the longer term, going back to 1970. Big move now, up well over what $700 an ounce. In the last 10 years, Keith, gold's been a little bit more of a flat line, I guess, if you will. But you started off our conversation by saying, in effect, gold was the eternal source of wealth. And it just made me think of a couple of years ago when Venezuela was really suffocating, and Russia basically sent a plane. And if you remember this story, but they sent a plane, they filled the plane up with gold, and they flew the plane back up to Russia. That at the end of the day, really what does maintain value over generations, untouched by everything else, as you said, that isn't a liability to anyone else. It's that gold in a safety deposit box that never seems to outlast the test of time.
It's right. I mean, everybody can put down gold as not being productive, which is, of course, what we're trying to do. But if you own a piece of metal, there's no counterparty. There's no such thing as default. Warren Buffett says, you buy a lump of metal, you stick it in your desk drawer. 20 years later, you take it out. It's still the same lump of metal. And what would happen if that was somebody's piece of paper from some firm that's a zombie? Is that still going to be around in 20 years?
Well,
Is that
because
currency going to be around in 20 years?
I have to also, as long as we're in the charts, it's definitely the language Seth knows that I speak. I have to bring up another chart, and Keith, I don't know if you can see this here.
Yeah.
You know what this is. This is a chart of Bitcoin. Gold or Bitcoin is, in a sense, positioning itself as the new gold. Millennium investors say, why do we need gold? We have Bitcoin. How are they wrong?
Let me respond with kind of a witticism. I don't know where I saw this. It could have even been on a post that you made, Jonathan. In science, knowledge is an ascending spiral. In finance, knowledge is cyclical. So right now, Bitcoin can do no wrong. And Michael Saylor and Elon Musk, who essentially, Saylor in particular, is issuing dollar bonds in order to buy gold and shove it on his balance sheet with a great deal of leverage. Elon Musk effectively doing the same thing, or at least arguably doing the same thing. And they can do no wrong, seemingly at the moment.
So you don't think this is a world-changing type? Look, we're objectivists, so we're not anti-innovation. We love technological innovation. You are dismissive of the idea that Bitcoin could be a technological innovation to money itself, money writ large.
I mean, I love the idea of the blockchain, and I think that's going to have some phenomenal applications. But at the end of the day, a currency system is the ledger that in the normal case includes asset and liability, right? So the bank raises funds. Let's say take a gold bank 150 years ago. They raised gold funds in order to buy a portfolio of bills in those days, and what it would have been. And today, who knows what, treasury bills and commercial paper and everything else. So there's an asset and a liability. I wrote an article called The Forking Paradise about this idea that you have forks in Bitcoin, and saying this shows, so my connection is Bitcoin is not sound and Bitcoin is not money. And one of my arguments is the fact that it could fork. That means that, imagine you have the Roadrunner Bank. I like to use Wile E. Coyote analogies in my writing sometimes. Imagine you have the Roadrunner Bank, and they have X number of depositors, and they have all these accounts. And then Wile E. Coyote quits one day in disgust and says, I can't take working here anymore. I'm going to set up a competing shop across the street. I'm going to steal your ledger book. And I'm going to say that everybody who has an account at the Roadrunner Bank, your account will be honored at the Wile E. Coyote Bank. Do we need to pass new regulations to prevent this new terrible crime? The answer is no, because if you didn't have the assets, the liabilities would be impossible to honor. But Bitcoin seemingly makes this magic possible. And when there's a fork, okay, granted the fork doesn't have the same market price as the original. The fact that it's non-zero it seems to indicate that there's free value being created somehow, and there's something fundamentally wrong, because it's a ledger of liabilities only, and people say, well, who's the debtor who owes that liability? And I say, well, that's part of the problem, is it's a collective public liability, and so people are trading these tokens, but there isn't anything really there.
I want to get into that. I want to get into that NFT thing in just a minute, but I want to quickly thank all of our super chat donators. You guys keep the lights on here at the Ayn Rand Center UK. Keith, I don't know what your opinion of the pound is these days, but Yasser Orstein sent us £5 with a question for you. If I can throw that to you. Yasser asks, do you think Peter Schiff's advice is correct and you need to invest in foreign countries in gold? And which countries would that be? He loves the topic.
So obviously, I'm a believer that everybody should own some gold, not necessarily as an investment. I mean, gold is just a piece of metal. It's when you hold money because you don't have any investment that you prefer. As to investing in other countries, I make the observation that all the other currencies are dollar derivatives. So if you think the dollar is headed down, the derivatives of the dollar couldn't survive, even if they didn't have their own problems, even if they weren't dirtier shirts at the laundry, which I think a lot of people have made that argument and made that analogy. The derivatives of the dollar, the derivative could never survive the collapse of the underlying instrument anyway.
So you don't see a situation where people should hold the euro and not the dollar, or hold the yen? To you, they're all fiat and they will all be displaced ultimately by gold.
Right, and all fiat currencies have the problem that there is no, the technical term would be extinguisher of debt. That is a way to finally pay off a debt, not just get yourself out of the debt loop. So if you owe $1,000 to somebody and you take out a lot of $20 bills, you're out of the debt loop. Nobody's going to sue you or call the cops or whatever. But you just handed over a pile of paper that says Federal Reserve notes on it. So you've just shifted the liability to somebody else's balance sheet. Now the Fed owes that person rather than you owing that person. Then that person will deposit it in a bank. And now the bank owes that person and the Fed owes the bank. So all we do is shift it around. But because there's no way to extinguish a debt, and all the debt is ultimately borrowed at interest, then I'm sorry, I lost my train of thought. The interest is added to the debt, and the interest can't be paid off either. So the total debt must necessarily grow by at least the accrued interest. And in fact, it turns out it's more than that. It has to grow enough that the marginal debtor can get his hands on enough dollars to service his debt. And so you were saying earlier about debt to GDP. I like to look at marginal productivity of debt, which is change in total debt or total credit market debt outstanding, but change in that divided by change in GDP. So, or change in, so that what that's showing is for each marginal dollar that's borrowed, fresh new dollar that's borrowed, how much GDP do you add? And that's a number that's been in secular decline. I mean, again, with jitter, since at least 1950, which is the oldest data set I've been able to get my hands on. And so it's terrifying. Everyone should ask the question, if we're scientists here, what happens when that gets to zero? Mm-hmm. So I wrote an article called the heat death of the economic universe. When you're adding more debt, but you can't add GDP anymore, what happens?
I want to thank Grant Shapiro for his contribution, Mary Aline for her contribution. Keith, are you on Clubhouse? Because, the real party, as they say, is on the after show on Clubhouse. Are you on Clubhouse?
I'm familiar with it. I don't have an account yet.
All right. Well, we'll see if you can join us. In the next 5 to 10 minutes, you'll be able to get an account together. Because, but Seth, I want you to add your perspective here too in our last remaining moments as well.
Sure. It's money is a fascinating topic to me. I'm going to quote my friend John Tabney. He's got a quote that says, "Nothing brings out the stupid like money." A little bit of pejorative, but I agree with him. There's all sorts of there's just there's a long lineage of, I think, good and bad literature on money, and I basically you can really find whatever you want on it. I think the idea, even just from a issuer perspective, I think the idea of issuing a gold bond is a gold backed bond is super interesting. I see how it's beneficial for the gold mining companies. I mean, if I was a gold miner, why would I want, well, I mean, the kiss of death for any company is having an asset liability mismatch. You could just ask WeWork about that. And this is pretty interesting, at least from a gold miner perspective. So I could see this definitely as a, as a niche issuance. And even I think from a lender perspective, I mean, why would you want to take this removes some of the risk, of the gold price from a lender perspective. So, I definitely can see there being a market kind of on both sides of the coin for it. I don't have an opinion on it. I wouldn't venture an opinion on this. No one called the SEC. This is just an opinion. But yeah,
but
I mean,
you have to say it's really amazing. And people say, oh, financiers, they just shuffle papers around.
Paper. Yeah.
Yeah, like, they don't do anything. You're not actually out there creating the gold, but creating a way to make the financing more efficient, to make the whole endeavor more profitable for everyone involved. Thank you, Bonnie Bertrand. Bonnie says, please have Keith and Seth back again. So Keith, you wouldn't want to anger Bonnie. She's a big fan. Thank you. Thank you. So it's just, Keith, you're inspiring. I don't know how much you feel like you've used objectivism in your innovation, but I know Seth and I are both really impressed with it and inspired by this true financial, this is our business as well. So to see this fascinating financial innovation and to have it spearheaded by an objectivist is just great all around. So it's a win for everyone. And we're just happy to be able to give you a platform to showcase it.
Thank you.
Good. Well, we'll want to remind people where to find you. It's Keith Weiner Economics is your blog. Correct?
Yeah, Keith Weiner Economics. And I was going to say, most of my monetary work is on monetary-metals.com.
That's what I was figuring, monetary-metals.com. And as well as on Twitter, you're getting to be a little more active there. And we hope people will continue to follow you there at keithweiner.com. Seth Levine, you read week after week at The Integrating Investor with fascinating articles, really, I won't say from an objectivist perspective, but from Seth's perspective, influenced, I think, by objectivism. He's at sethlevine.2. And Seth, you've become such a regular here at the Ayn Rand Center UK, and the Lord Emperor knows how to spot talent. He really is. So tell us about something that's, briefly, if you would, what's going to be new and exciting for you in the coming weeks.
Yeah, so very, very, very excited to announce that I'll be more of a regular on the Ayn Rand Center's podcast here. I'm going to have a show starting on April 9th, probably called The Integrating Investor, where I'm going to just go and try and share some of my perspectives. Definitely not objectivist, but I think Jonathan, as you point out, really an application of what I know of objectivism to living in the real world, because as we all know, objectivism is the philosophy for life and living in the real world. There's no point in just studying it, well, unless you're truly interested in it, right? The point is not to study the philosophy and just, regurgitate it. It's about going out there and living. And this is one of my ways that I apply, objectivism to my life. My website's right up there, integratinginvestor.com. I'm on Twitter at SethLevine2, no dot. I look forward to kind of interacting with everyone on the show on April 9th.
We couldn't be happier to have you here at the Ayn Rand Center UK. And there's a very sketchy hazing ritual now at the Ayn Rand Center UK. They make you down one of those huge pints of beer, which is for an American is like multitudes of what I know I can drink. So maybe you'll be able to handle that.
Yeah. the horrors. Maybe I'll have to start 2 shows then.
Well, let's continue the conversation about finance in Clubhouse, if you're up for at least for a little bit. Keith, if you won't be able to join us this time, but we hope you'll join us once again in the future. And we really appreciate you sharing all your perspective with us. Monetary-metals.com. Keith Weiner, follow him all over the atmosphere, the blogosphere, and keep it up. You're an inspiration in all that you're doing.
Thank you.
Yeah, and I should just mention that's going to be at 8 p.m. UK time, 3 p.m. Eastern. Sorry to leave that out, but I'm sure there'll be more announcements to be made.
Good. So share, like, and make us part of your daily media diet. We'll see you back here again soon.